Welcome to Big Mike Fun Podcast by Mike Zlotnik.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and it is my pleasure and a privilege to welcome Matt Hamilton. Matt is a CPA and the founder of Surefire Tax and Accounting, where he works with commercial real estate operators, syndicators, fund managers, and family offices on partnership taxation and deal structuring. Before founding Surefire, he spent 8+ years in real estate and private equity tax at the two nationally real estate recognized firms. One of them is Novogradic, if I'm pronouncing it correctly, and Company and Whole CPA. So welcome to the show.
Thanks for having me. It's great to be here.
Before we go into a very exciting field of tax accounting and depreciation and bonus depreciation and some of the best strategies, a couple of words about you. Where do you live? Family, kids, cats, pets, whatever works for you.
Yeah, no, I am in the St. Louis area. I have a soon-to-be 11-month-old son. He turns 11 months old in like 3 days. So spent a lot of my time, a lot of sleepless nights, but it's great. Yeah, no, I live here with my wife. It's summer, so it's time for, it's like pool season, smoking meat and having a good time. Yeah, no, it's that's a little about me personally, but yeah, it's everyone's favorite topic, tax. I'm one of those freaks that, enjoys talking about tax and, learning about tax. So I'm happy to be here to kind of chat about the subject with you.
Yeah, I appreciate you coming on a podcast and tell us a little bit about kind of, I know Brandon Hall and Whole CPA, you spent a number of years working there, a lot of professionals, and I'm sure you've seen everything. So just curious, what asset classes have you worked with? Obviously, multifamily, everybody does multifamily, but also have you done industrial, retail, sales storage? Just curious kind of your breadth of your expertise, and then we'll dive into some specific questions.
Yeah, absolutely. So like you said, everyone's kind of done multifamily. Multifamily is the one that you just see most commonly, but I've worked with syndicators and fund operators who are in the industrial space. There's a lot of folks investing industrial at the moment, so that's kind of a booming space. Some mixed use retail, industrial, a lot of short-term rentals as well. A lot of people have kind of accumulated single family homes, converted them into short-term rentals and kind of operated funds that way. And also like campgrounds, RV parks, mobile home parks. That's another booming asset class at the moment. So I've kind of run the gambit of all these different asset classes, but the ones I primarily see the most are, multifamily, industrial, and mobile home parks.
That's wonderful. So what's so great about those asset classes? So we know multifamilies got beaten up pretty hard in the last cycle. It's just got really beaten up hard. And at the same time, industrial, retail, and mobile home parks have done remarkably well. Kind of dichotomy. I don't know if you have any quick comments on why it has happened. I'm just curious I know you see the tax side, but I'm just curious if you've seen anything beyond that, any conversations with sponsors, fund managers, operators, just sort of from your experience.
Yeah, I think with industrial specifically, there's just a lot less volatility in the assets specifically, because if you underwrite the fundamentals really well and you bring in a sound tenant that is going to be there a while, if it's a single tenant property, maybe 2-tenant property, there's a lot less volatility in the financials compared to the pro forma and the underwriting and all of that, and just makes it a much not less risky investment. Obviously, there's a lot of risk in having all of your eggs in one basket, but I've seen a lot of people really hone in on reducing that volatility in that direction. Also, I think there's an opportunity now with converting large industrial space into data centers and other opportunities that didn't exist just a handful of years ago.
Very cool. And by the way, I'll just add one comment. Yeah, you have a risk concentration in a single tenant industrial, but at the same time, it could be beauty on a curse. Curse if they leave, beauty if they stay, and it's all in their underwriting. And a couple of weeks ago, I was at a mini conference and I was meeting with one of the largest, significant operators in the space, and the default rate isn't remarkably low. Most of these industrial tenants just stay. They stay and pay, and that's been maybe reindustrialization of America, but it seems to have worked. All right, let's go to the tax side. So let's compare and contrast. Just think for a second. Tax benefits of different asset classes. Let's start. You've got industrial, you've got retail, you've got multifamily, you've got self-storage, you've got mobile home parks or manufactured housing communities. Which of these asset classes has the highest tax benefits if you are trying to get a bonus depreciation? And the reason it's important is because bonus depreciation is back. Last year, they one big beautiful bill. So people who care about bonus depreciation probably want to know which asset class gives them the biggest buck for the invested dollar as far as the bonus depreciation.
Yeah, I think to answer that question, I think you need to back up a little bit and kind of understand what creates and drives bonus depreciation across these different asset classes. So whenever you buy a property, you're not just buying the property, you're buying the land, the building, the roof, the doors, everything that goes along with the property. And you can do a cost segregation study that basically takes your purchase price and allocates a portion of that cost to each individual component. Why that matters is these different components have different depreciable lives. And where bonus depreciation comes into play is any asset that has a depreciable life of 5, 7, or 15 years. So these are personal property. This is all personal property and land improvements. Those are all eligible for bonus depreciation. So that is basically anything that is either a land improvement or not permanently affixed to the property. So some examples of things that are not bonus eligible would be the roof, the HVAC, the plumbing, the electrical, the windows, things that are, permanently affixed to the property. But some items that are bonus eligible would be land improvements like, parking lots and at an RV park, maybe like a pool and the
Plumbing,
plumbing
electric.
and electrical to kind of connect everything, all of that. And personal property, if we think multifamily with, appliances, that it comes furnished, things in common areas, all the furniture and fixtures there's a lot of different components that are bonus eligible across different asset classes. So when you ask like which asset classes produce the most bonus depreciation, what we're really trying to understand is which asset classes come with the highest rate of personal and land improvement property. So industrial, we were just kind of talking about how some of the benefits of industrial. It's actually one of the asset classes that has the lowest rate of bonus depreciation because the property is primarily just the land and a large sort of box. It's just kind of the roof, the
What
walls.
about tenant improvements? If you're a landlord that doing tenant improvements, building out, some space for the tenant, is that, I'm just curious. So obviously you got the big structure, right? And most of it you can't bonus depreciate because it's foundation, it's the walls, right? But what part of the industrial you can bonus depreciate? Just curious, just a quick.
Yeah. So any tenant improvements that are specifically to get the property ready for a tenant to move in, that can all be, generally speaking, considered qualified improvement property or QIP. And that is also bonus eligible. So there's some opportunity there as well with industrial, but you get less of it right off the bat if there isn't like a large amount of tenant improvements that need to be done in order to lease the property immediately. And then kind of going back to your original question to kind of move up the lane. Multifamily is usually kind of right in the middle. And mobile home parks and RV parks, campgrounds, all of the properties that you when you buy them, maybe you don't even own the homes themselves, but nothing is kind of permanently affixed to the property. Those generally have higher rates of bonus depreciation because most of what you're buying is land improvements and maybe the blocks, the hookups, all these things that are not real property in the traditional sense. It's not a building with foundation and doors, windows, etc. So that's kind of what you're looking at when you're looking at the tax benefits of different asset classes.
Yeah, that's actually great clarification. As I'm thinking through the process, manufactured housing communities, pretty much everything is just land improvement. I mean, everything other than the land, right? So whatever value you just allocate to land, but everything else is an improvement, and then you can bonus depreciate that. And I guess that's why it does so remarkably well versus everything else. And just to cover self storage and retail, they're pretty similar to industrial, right? They don't co-seg well because they just have big box structure, and then there isn't that much personal property or improvements.
Yeah, no, that's an accurate assessment.
So how do people use it? So you work with just a classic. I mean, we're going to go into a little bit of active versus passive, and then basically who could use the depreciation to write off against their other income and who cannot. Just cover a little bit on that topic.
Yeah.
Because if you're a real estate professional, it's one thing. If you're not a real estate professional, you're by definition a passive investors and you're getting these passive losses and you can't really do anything other than offset passive activity. But what do you think? What, from your perspective, kind of as a CPA, what can be done?
Yeah. So generally speaking, whenever you have activity that you're reporting on your personal tax return, whether it's income or losses or anything in between, everything falls into one of two buckets, either passive or non-passive. And to make things easier, let's just call it active. So your active income, that's things like your W-2 income. It also includes portfolio income, like interest income, dividend income, all of that. And your passive activity is going to be things that you do not materially participate in and real estate. So businesses that you don't materially participate in that you may own, and then obviously, real estate. So real estate by default is considered passive activity. And this matters because passive losses can only be used to offset passive income, whereas non-passive losses can be used to offset your non-passive income or your passive income. So the question becomes, how do you move real from that passive bucket into the non-passive bucket? And that's where real estate professional status comes into play. So if you're a real estate professional, meaning that you work in real estate at least 750 hours a year or more than anything else you're doing, that can be, you can claim to be a real estate professional and you can move all of your real estate activity into that non-passive bucket, which is a major unlock. If you have maybe a spouse that has a W-2 income, you can use that to offset it. But for many folks, becoming a real estate professional is not really plausible. If you work a full-time job, the IRS is not going to believe you when you claim to work two full-time jobs and be a real estate professional. So your options are kind of limited there if you're not a real estate professional, and things sort of get stuck in that non-passive bucket. And there's ways to kind of take advantage of that and utilize those passive losses to maybe use in the future and kind of get creative a little bit. We can get into that, but that's kind of the baseline of all of your activity and the different buckets that all of that activity kind of flows into.
Yeah, that makes sense. I appreciate that explanation. And yeah, for REPs, it works. For non-REPs, spouse, right? That's the easiest path to get an REP, a real estate agent, and just spend that 750 hours a year. And it's the 750 test, and it has to be the primary activity. If you do something else, it can be more than real estate in essence.
Yeah, correct. And it's also worth noting that real estate professional status is one of, if not the most audited area in the tax code. So if you are claiming real estate professional, just pro tip, just make sure that your T's are crossed and I's are dotted and you're working with a professional to make sure that everything is buttoned up in case the IRS comes knocking and have some questions about it, because the burden of proof is ultimately on you to kind of prove that you are a real estate professional.
Yeah, that makes sense. Back to the advice, work with a good CPA to make sure you're doing it by the book. So now let's talk a little bit about, we were chatting before the call, what to do when you're selling a property and how to mitigate taxes. And a lot of times people use 1031 exchange. And there's a concept of lazy man's 1031 exchange. Another concept I heard it pseudo 1031 exchange. Another fancy term, passive loss harvesting. It's kind of like a part of that whole exercise. So we just talked about passive versus active losses, but essentially depreciation. When you get your K1 and you're not a real estate professional, you get a passive loss. You can harvest those losses to offset gains. So let's talk about traditional 1031 and then lazy man's 1031, kind of explain the difference and how depreciation can play to help do a lazy man's 1031 exchange.
Yeah, absolutely. So 1031 exchange, the traditional 1031 exchange, how this works is the taxpayer has a direct ownership in a real property. You sell it, and instead of paying tax on the gain immediately, what you are able to do is defer that gain by redeploying the proceeds from the sale into another real asset. So that like kind exchange. And the like kind is what's really important here. It has to be real property exchanged for real property. And that deferral, and you can keep doing that deferral over and over again. And that's why the 1031 exchanges are very common. It's something that's talked about a lot in the real estate space. But when you get into fund investing and maybe investing in syndications or passive real estate investments, you run into this issue that breaks that like kind exchange, meaning that you can't, let's say you own property and you want to redeploy the sale proceeds into a fund. You can't do that because you're not exchanging a like kind asset. You have real property on one side and ownership interest in an LLC that owns real estate on the other side. Creates this break in the like kind exchange. And that's where that lazy 1031 exchange comes from.
Yeah, understood. And that the other piece to this is if you're selling, a syndication, or not you, but you're an investor in a syndication and a sponsor is deciding to sell appreciated industrial property. and the result are passive gains, right? And how do you do that? What's lazy man's 1031 exchange, and how do you offset these gains that are generally taxable with a fresh bonus depreciation?
Yeah. So with the lazy 1031 exchange, this is taking advantage of that passive bucket that we were talking about earlier. So a lot of people see having all these losses stuck in this passive bucket as a negative and often ask themselves, how can I get these passive losses over into the non-passive bucket? But the lazy 1031 asks the opposite question. How do I get my income into the passive bucket to take advantage of these passive losses that already exist? So in your example, you're invested in a syndication and the LLC sells the property and distributes you, the shareholder, liquidating distributions, your share of the sale proceeds, and you're going to receive a K1 with your share of the gain. And let's just say it's $100,000 of gain and you're distributed $150,000, $200,000 of cash, and that's your final K1. What you could do is, because all of those real estate activity, you're not a real estate professional, that's all considered passive income. Those are passive gains. So what you could do is in that same tax year, make an investment in a different real estate investment that would create passive losses through bonus depreciation, through front-loaded bonus depreciation, and use those losses to offset the passive gain that you've just created. So how this kind of plays out, you sell the property, you get that $200,000 of cash, you have $100,000 of gain. You take that $200,000 and in the same tax year, you invest it in another syndication that's maybe it's a mobile home park and it's got like a 50 bonus depreciation rate. So you take that $200,000, you invest it in this mobile home park investment, and you get a K1 with $100,000 of real estate losses in year one. Well, now you have a K1 that has $100,000 of passive losses and another K1 with $100,000 of passive gains. They offset each other, and you've effectively redeployed your sale proceeds without paying tax on the gain in the current year. So that's kind of how the lazy 1031 exchange works in practice with a kind of a concrete example.
Yeah, that's a great example. I just wanted to add to the numbers again. Obviously, numbers, we're very project by project. But in a mobile home park, if you invest, 200,000, you're probably going to get way more than 200,000 in the first year bonus depreciation if there's any kind of debt leverage, right? So it depends. There's some ratios that I've seen in the industry, but they vary. What's really fascinating for investors, classic example, just I discuss it with other operators. If it's a $10 million mobile home park and it gets bought with 60% mortgage and 40% equity, the first year bonus depreciation on that project could be $6 million, sometimes even more. I'm sure you've seen it. It's kind of 60%, not even 70%. It's kind of crazy. And because of the even conservative debt leverage, project gets $6 million worth of bonus, and the equity is only 4. So you take 6, you divide by 4 million, you have 1.5x ratio. So $200,000 investment in this math, in this example, generates $300,000 loss. So passive loss. And if you have only $100,000 passive gain, you carry forward the other 200,000, or you don't need to invest as much. If you just want to offset that gain, all you have to invest is enough that'll give you fresh depreciation to offset the expected passive gain that you get from the sale of that appreciated asset. Just curious, any quick comments? You could do a little bit of tax planning. I think what's important is for you to do planning. If the thing sells July 1st, right? Your property sells July 1st, you have 6 more months to redeploy the money, but you don't get the K1 until a year later. So how would an investor should plan? How should they plan? How do they get an estimate of what the K1 can look like so that they know how much to redeploy? I'm just curious, like, have you talked to people about that?
Yeah. So the planning it usually doesn't happen. Partially because the investors don't have the information they need. And 2, maybe they're not even aware that there are options available to kind of offset these gains. But the way I always like to think about it is whenever you invest in a partnership, you have what's called a capital account. And that's equal to the cash that you put in, plus any income you're allocated, less any distributions you receive, less any tax losses you're allocated. It's a very simple math equation. It's just addition and subtraction. And generally speaking, at the end of the life of that partnership, your capital account needs to be 0. So you can really estimate what your tax allocation is going to be in that final year if you know what your capital account was on your K1 the previous year. And let's say the property sells in March and you already got your final distribution in like April. So you already know the cash that you're getting. So it's just a very simple number to back into. So you really are able to calculate that number pretty easily once you know what that final distribution is going to be. So that's kind of the first component of planning.
Let's stop for a second. So the
Yeah.
math is extremely simple. You get your final distribution. You put in 100,000. You get $200,000 distribution. That's a cash receipt, right? And you look at your capital account for the previous year, and it says, just for the sake of the argument, it said your capital account is 50,000. You put in 100, you got depreciation losses. Your capital account says 50. So you expect if passive gain is $200,000 cash receipt minus what the K1 for previous year shows 50. So you expect to get $150,000 gain, passive gain. Is that how it works?
Yeah, that's a really good like back of the napkin. Obviously, there's some nuance that could kind of like wiggle the numbers around a little bit, but like back of the napkin, if you're doing tax planning, that is exactly how I would calculate the number.
Okay, wonderful. So once you know back of the napkin, of course, it's all an estimate. I know CPAs don't like to say that's 100% until they get the K1, and there's different allocations and different items on the K1, but big picture, right?
Mhm.
So all you have to do is look at the new deals and get a good estimate from the fund manager or sponsor or operator, what kind of cost seg might, what kind of loss they might generate on a new project. Or just buy yourself and talk to a cost seg engineer in advance and ask them, hey, can you give me an estimate upfront? Is that, I'm just thinking through the process, right?
Yeah. Yeah, no, that's exactly it. And you kind of hit the nail on the head. You have a lot of optionality here because you could just take that cash and invest in a property directly. You don't have to necessarily go through another partnership. It gets you to the same result. But if you're talking to different operators and different GPs that are in these deals, the questions you want to be asking is, generally speaking, what kind of cost segregation, bonus depreciation should I be expecting in year one with this particular investment? If I were to invest, $100,000 and just kind of go from there. Those are the questions you need to be asking because you did the back of the napkin math and you know about what your target number needs to be in order to execute this properly. So that's exactly the process that I would follow.
Yeah, I appreciate that. It's remarkably simple, but like you said, many people don't do this basic planning. They just get that cash, they're happy, they don't think about it, but it needs to be done in the same calendar year. This pseudo 1031 has to be done in the same calendar year to defer those gains with the fresh depreciation.
Yeah, which creates complications if the sale and exit is happening in Q4. It kind of ties your hands with, the amount of time that you have to redeploy that capital because you are limited to that calendar year, tax year.
Or you pick up fresh cash, right? You have a sale event that's closing in December. You just don't have enough time to redeploy the money. You have to get the cash somewhere else, put the money in a new deal. And then worst case, what happens in that worst case scenario, if the sale gets delayed, you still get to use the fresh depreciation, right? And if you can't use it, it'll just carry forward. So there's no drawback by...
Yes. So in that example, what would actually happen is you would invest in that new project, you would get all this bonus depreciation, you'd get these passive losses that you can't utilize, and they're just going to be suspended and carried forward into next year to offset those losses in the future. So really the only thing you're out is, if you had to borrow money, any debt service on the spread between when you made that investment and when it sells. But from a tax perspective, it really doesn't make a huge difference.
Yeah, makes sense. Just thinking, planning out loud. And obviously investors should always think about the merits of the investment ahead of the tax efficiency.
Absolutely. Yeah.
I love the expression. Don't let the tail of the don't let the tax tail whack the wealth dog. If you ever heard that expression.
Yeah. No, I say that all the time, but like whenever I say it, I always mess it up and say, "Don't let the dog wag the tail," and I'm like, "Yeah, it's backwards." But you know what I meant. But,
the wealth dog and the tax tail.
Yeah, exactly.
Matt, how would folks reach out if they wanted to talk to you to better understand, how the individual circumstance working with you on planning basis? Obviously, if they need tax and accounting advice, just a couple of words about your advisory services. And we talked earlier today, completely separately, but just give folks a little bit on overview. What is your advisory services and tax, and compliance work, and to help with folks reach out?
Yeah, absolutely. So I primarily work with GPs and operators in the syndication fund space where we kind of do some advisory to help put the deals together and pencil out the allocations and the operating agreements on everything on the front end, just to make sure there's no surprises whenever the K1s go out on the back end. And I also work with, on the compliance side and getting all the partnership returns done and the K1s completed. I also work with investors who are trying to execute these lazy 1031 exchanges as well. Oftentimes, my clients come to me and say, "Hey, I have someone who's wanting to, kind of bring capital into the deal, but they've got this 1031 exchange issue." So I work with them as well. The best place to find me is on LinkedIn. I'm very active on LinkedIn. If you just search Matt Hamilton CPA, I'm there on LinkedIn, and I have a link on LinkedIn to book a call with me, and I do discovery calls for free to kind of assess whether or not it'd be a good fit to kind of work together, and where I might be able to add value to the situation that you're in and where you want to go. So that's the best way to find me and what I can do for you.
Matt, thank you for coming on a podcast. Thank you for sharing. Thank you for some of the nuggets, and enjoy the summer. Enjoy some barbecue with the family. And you have a small kid, and it's the best time. They're sweet, and it doesn't get any better than summertime hanging out with the family. So enjoy.
Yeah, I appreciate that. Thanks for having me.
Thank you.